In this video, I want to discuss withdrawing money from an annuity, show you the different ways in how somebody can withdraw money from an annuity, specifically for their retirement income needs, and then what are some common mistakes that individuals make when they're setting up either the wrong annuity for a specific situation or they don't have a plan in place. So it's really going to cover a whole gamut of different things, different pros and cons, to make sure that you could leverage these strategies effectively. The most basic form of withdrawing money from an annuity is known as annuitization. And this was very popular when annuities were first created. Individuals didn't necessarily like this that much, and really the income riders have taken place off of giving somebody control of their account value, control that they could leave their account balance to beneficiaries and still receive a lifetime income payment. So with annuitization, I want you to think of it like the opposite of life insurance. With life insurance, an individual is paying monthly premiums or annual premiums to an insurance company, and that insurance company is producing a lump sum benefit to that individual's beneficiaries upon their date of death. So what's happening is the individual is leveraging the life insurance, and the life insurance company is leveraging their general accounts and the law of large numbers to say, okay, we're going to determine how long this individual should be living, and therefore if they're paying us premium payments, if they pass away in a year, if they pass away in 70 years, we will still leave some sort of lump sum benefit to those beneficiaries. It prevents an individual from dying too soon, so it gives them an insurance, it gives them a protection in case that individual dies too soon, that they could provide a benefit to their beneficiaries as if they were still working and accomplishing whatever those financial needs are. With annuitization, they're still leveraging the insurance company to utilize the law of large numbers, their actuarial data, using basically some sort of protection, but instead of protecting themselves from dying too soon and providing that benefit to beneficiaries, what they're doing is they're leveraging the insurance company to produce a cash flow, an income stream every month or every year to the day that they pass away. So ultimately, it's the opposite. They're giving the insurance company a lump sum dollar amount. It's going to the insurance company, and then the insurance company is saying, okay, based upon your age, some carriers based upon your sex, they will go and determine how much lifetime income that you would be receiving. So if, let's say, somebody gave $100,000 to an insurance company, and this insurance company says, okay, we're going to give you $7,000 every year to the day you pass away, we understand, okay, well, what's the risk there? Well, if this person, let's say, is 60 years old and they're able to receive $7,000 per year, that's a 7% cash flow from their original $100,000 deposit. If they live for only a couple of years and they pass away, well, then the insurance company, they only paid out $7,000 the first year, $7,000 the second year, $14,000 was total paid out, and the insurance company in this example would be able to keep that remaining $86,000. So the risk that was involved was the individual, they died sooner rather than what they expected to get past that break-even point, and the insurance company basically was able to keep the rest of those monies. So that's why old-fashioned annuities really leverage this type of annuitization factor. And this is, if you conceptually think of it like a pension plan, when somebody has a single life only pension plan, that's ultimately what's happening. They're receiving an income stream every month, every year, and then when that person passes away, the income stops, and whatever that benefit was basically goes back to the entity. Same thing, it just goes back to the insurance companies. So a lot of people didn't like that, but they understand the importance of, I want to make sure that there's some sort of income protection there in case I live too long. So in the same example where somebody's 60 years old, let's say that they're getting a 7% cash flow off of this $100,000 that they're giving to the insurance company. And what happens if they don't pass away after 2 years, but they pass away after 30 years? Well, this means that they would have put in $100,000 at age 60. They would have lived to age 90, 30 years. And then they would have been paid out $7,000 per year for 30 years, which is $210,000 total. So right when they got past that $100,000 marker, where they were paid back all $100,000 and then some, now they're basically, winning out on the deal. The individual's winning, and they're leveraging the chips or they're leveraging the insurance company to make sure that that income is still coming to them year by year by year, and they have all this extra net profit, and it only cost them $100,000. So this is where sometimes individuals say, okay, well, I like that concept, but I cannot stomach the fact that if I give $100,000 or $1 million or 500,000, whatever that dollar amount is, if I pass away too soon, I come down with some sort of ailment, cancer, I get hit by a bus, whatever that cause and effect might be, they built up that nest egg for all those years to therefore be able to leverage this. And many times individuals want to be able to leave this to a beneficiary. They want to make sure that they're leaving some sort of legacy. If they can't enjoy it, then they want to make sure their loved ones can enjoy it. So this is where the income riders came into play, and it's really, made annuitization fall by the wayside. So all annuity contracts have annuitization features with them, but that doesn't mean that somebody uses an annuitization to trigger lifetime income. More of these, and what I like to call hybrid annuities, they came out in early 2000s, and it allows an individual to have control of their account value, allow the account value to grow. If you're leveraging like a fixed index annuity with an income rider, it grows when the market index that's linked to it increases, gains 0% whenever that market index goes down, and it still produces them the lifetime income stream like they would have with an annuitization feature. So in that same example, let's say if they were giving $100,000 and the top insurance company that came back was producing 7% cash flow, but it was through an income rider, not through annuitization, and this person is age 60, unfortunately only lives for 2 years, and let's just say all things being equal, there's no growth onto the accounts, there's no losses onto the accounts other than the money that's being withdrawn. If they pull out $7,000 the first year, $7,000 the second year, there's be $86,000 remaining in this bucket. This person passes away at age 62. Now the beneficiaries could receive the $86,000. If, let's say, same sort of situation, this person lives for 30 years, they would have received back $210,000 of income. There would be no account balance after those $100,000 were eaten up. And once again, just keeping things level, saying that if there was no market growth in there, and it was just saying, okay, pulling out 7,000, 7,000, 7,000, we understand, that break-even point would have been at that $100,000 marker, and they would have $110,000 of pure profit because they lived a nice long life, and they were getting paid that 7% cash flow, since inception. So both of these features could be utilized effectively. You have to be careful of the carriers that are offering these contracts, because you have hundreds and hundreds of carriers, hundreds and hundreds of offerings, and majority of them are complete shit. I apologize for, cursing, but it's just the truth in some situations, or in a majority of situations. So if you've ever seen bad press about annuities, you have to be mindful that a majority of the offerings are bad offerings, but there are some diamonds in the rough. So like in a given situation, there might be 900 different offerings that come back, and out of those 900, 890 of them are horrible. 10 of them are pretty good, and then out of those 10, maybe 3 of them are very good for an individual situation. That's what we specialize on, is we make sure if somebody needs an annuity and they're trying to receive some sort of cash flow on there, regarding their situation, we always want to make sure what's the smallest amount of dollars that they could place into the best possible annuity account, and only as much as necessary. So what I mean by that is if they have a specific income gap, after they're looking at what their assets are and what their already guaranteed cash flows are through Social Security or pension income streams, and there's a specific gap there, they could suffice that gap by leveraging an insurance product, longevity insurance, through an annuity account. So majority of the times, or really more recently in the last 10, 15 years, the annuities with the income riders have been a fantastic avenue for those individual situations. Now, when I say bad versus good, what do I mean by that? Well, if you have the top carrier out of 900 plus different options, if let's say the top carrier is producing a 8% cash flow, so if somebody gives $100,000, they're going to receive back $8,000 of income, versus the, let's say, 10th place is going to produce a 6% cash flow, why would you go with the 10th place option? Because if, let's say, somebody's need was 20 grand, as an example, they needed to receive income of $20,000 per year. All you do is you take what the need is, divide it by the top cash flow producing product, and that's how much would be the smallest amount of dollars and only as much as necessary to place into that plan. Let's say somebody accidentally went with the wrong carrier, or they mistakenly went with the wrong carrier, and they went to the 6% guaranteed cash flow type product. They're going to have to pay $333,333 with this company, let's call it ABC, versus the top carrier, which produces an 8% cash flow. If they needed this $20,000 of income, it would only cost them $250,000. So what this just did was save this person over $83,000 by just using simple math to make sure that they were accomplishing their goal. And if, let's say that their account balance was at $1 million, what's better, to use $333,000 of that million to go into an inferior product, or use $250,000? So now you have $750,000 left over to leverage towards other growth-related plays or ancillary-related goals. So I hope that all of this makes sense. Now, an individual would leverage an insurance company and leverage that annuity because they know that they cannot outlive that income stream. If somebody was trying to invest their monies and they just said, okay, I'm going to leverage a growth-related strategy, but just pull out monies accordingly, that's where you start getting into some withdrawal strategy rules known as the 4% rule, which allows you to pull out up to 4%. There's about a 90% chance of success that you're not going to outlive your monies. So this is where, in my mind, it gets sticky with certain situations, because investments are great, but it's great when you're trying to leverage it towards a growth goal or an ancillary goal. The trick with making sure that investment and growth-related strategies work is when you don't have to rely on that for an income stream. The trick for making sure annuities with either annuitization or income riders work is when you're trying to leverage this for an income-related strategy. You're not trying to leverage these sorts of accounts for a growth-related strategy. So each one is sticking to its specific lane. I'm going to explain that concept in more detail when I get to the example solution. So, I hope that both of these make sense. This is more of those traditional old-fashioned annuities. A lot of individuals didn't like that because it makes them lose control. The income rider allows them to maintain control and make sure that they're leaving something to beneficiaries, and they also have certain get-out options. So you might have certain restrictions with these types of accounts with income riders, but that restriction might go away after 7 years or 5 years or 10 years. It really just depends upon what sort of account and product that you're in, where you could always take all the money from there and place it into something else if, let's say, interest rates increase, and you could leverage that sort of interest-related strategy as an income play. So now I'm going to segue into the interest-related accounts and how somebody could try to pull out monies from an annuity if it's some sort of fixed interest or index-related interest account in there. So the most common one would be a fixed annuity, and this was an effective income-related strategy back in the 80s and the 90s, the early 2000s. And what it used to do is conceptually compete with a bank CD. So if, let's say, a bank CD in the 1990s was paying 10%, and you had a 5-year bank CD paying 10%, you might have had a 5-year fixed annuity that was paying 12%. So if somebody has $1 million account and they splice the different fixed annuity related accounts from this $1 million, they would be able to receive 12% interest, which is $120,000 of just pure interest every year. And let's say if this was a 5-year account, $120,000 the first year, $120,000 the second year, $120,000 the third year, et cetera, et cetera. After 5 years, they'd be able to walk away with their original $1 million principal. So that was an effective strategy because they would just be using whatever the interest rate environment was to use those interest rates for their cash flow related need. Now, unfortunately, everything has really fallen by the wayside. So the same 12% or 10% bank CD or 12% fixed annuity is now only paying about 3%. And that bank CD is now only paying about 1%. So this is no longer an effective strategy to go and hoard away all those monies, have some sort of restricted liquidity on those monies for such a measly interest rate on there. So this is why individuals tend to go towards things with income riders and things that will actually have a lifetime income stream, as opposed to only a fixed interest rate for a set duration of time. More recently, you have accounts which are what I coined the term naked fixed index annuities. So it's a fixed index annuity without any bells and whistles, without any sort of income riders or death benefit riders that could have a fee that's attached to it. Things that might have some uncapped indexing strategies, so it could give you a decent rate of return, or just a rate of return that's paying better than some of the more fixed interest rate environments right now, where you either receive a rate of return or you receive 0%. A rate of return or 0%, there's no downward market losses and there's no fees associated with those types of accounts. So individuals can leverage those sorts of interest accounts for an income play as well. So similar to how a fixed annuity works, let's say if a fixed annuity is only paying 3% per year right now, we know that if the market goes up, this individual is going to receive 3%. If the market goes down, this individual is going to receive 3%. Everything's fixed. With a fixed index annuity, if let's say the index that they're linked to, just say it was an uncapped index, and that index went up 10% the first year, they would receive a 10% gain into their bucket. If let's say it went down 10% the second year, they would receive a 0% credit into their bucket. If let's say it went up, 7% the third year, they receive a 7% credit into their bucket. Let's say it went down 30% the fourth year, they would receive a 0% credit into their bucket. So ultimately, individuals could leverage this as a type of bond alternative, somebody that wants to be in a more of that fixed income related space, but they don't want to have any sort of risk with interest rate environments, because when interest rates increase, that could put a pressure against bond values. So somebody that just wants to say, okay, I'm placing my money aside, I don't want to have any sort of market risk associated with it, and I still want to have some sort of consistent rate of return on my monies, that's where they could utilize a naked FIA. But once again, you have to be careful with naked FIAs, because a lot of the offerings out there are complete shit, but you do have some decent diamonds in the rough. Once again, that's what we specialize on. We look at these things every day, every week. We look at the top offerings, and we let somebody know, okay, this might be a viable solution for your specific situation, for your specific goal, or not at all. Hang back, and maybe in a couple of months something favorable would work out based upon your age, based upon the state, based upon really what your what your growth or income related strategy is, what you want to see. So I hope that all this makes sense. Next, I want to go over the problems, which I did key on some problems over there, is setting up the wrong annuity plan for your goal. We see this so often, especially with these income rider related products. And what happens is you might have some sort of marketing platform where you'll have company XYZ, and they're going to display their annuity. You might have a financial advisor or an annuity salesman that tries to let you know, oh, if you put your money into this account, you're going to get a 7% guarantee on your money or a 10% guarantee on your money. And that is not the truth. Anything with an income rider, when you hear this outrageous 7% guarantee or 10% guarantee, when the interest rate environment right now is only paying 1%, you have to look into this a little bit deeper. What this 7% or 10% is discussing or is talking about is known as a roll-up on an income base, on basically a calculation account that's going to determine how much lifetime income that you're eligible for. So the reason why I say setting up the wrong annuity plan for your goal, if we understand that somebody has, let's say, $1 million of assets, they're receiving Social Security income of $40,000, as an example, they're receiving pension income for $50,000, and their expense need throughout retirement is only $60,000. Well, they're receiving guaranteed cash flows of $90,000. They have $1 million of assets, and they have a $60,000 income need, to basically suffice their expenses. Their cash flows are already sufficing what their expenses are. There's no reason in the world why you should put more monies into an annuitization-related product or an income rider-related product to produce more income if you're already sufficing your income by this large, delta, this large variance of you're already in the green. You're already winning that much further every single year. Now you could leverage growth-related strategies with this million. You could leverage the investments. You could leverage safe accumulation accounts. You could leverage, naked FIAs or fixed annuities if we're on the annuity topic, or bank-related products. There's so much more control you could do as opposed to just saying, oh, well, this advisor told me I have a 7% guarantee, so let me just go and put my money with that 7% guarantee. You have to look through the verbiage. You have to look through it. Always look for the problems. Kind of like I have oncologists. I have doctors that they are cancer specialists, and they say, okay, if I'm looking at different skin cells, my fixation is going to be on always looking for the cancer, always looking for the cancer. Even if somebody's healthy, I'm always going to be spotting and trying to look for the cancer. That's the way that you have to look through a lot of these annuity accounts, is look for the bullshit. See, these companies aren't going to be that nice. Now, there are, once again, diamonds in the rough, but you have to make sure that you're understanding it. It has to be very specific to your needs, very specific to your goals. And annuity could be a fantastic solution, could be a fantastic situation, but you also want to make sure that you avoid the cancers out there, because there is a lot more cancer out there than actually good products for a typical individual situation. And that really correlates to this next problem, is choosing a random company versus a precise result. I mentioned that why would you go with an inferior product if you could go with the top product? If you have a cash flow related need and that's producing an 8% cash flow, why would you go into the company that's only giving you a 6% cash flow? Doesn't make any sense. If you're trying to use it for income, use the most effective income strategy. It's just like saying, okay, I'm going to go and get a fixed interest rate at a bank, and I have one bank that's going to pay me 3%, but I have the other bank up the road that's only going to pay me 1%. I'm going to go to the bank that pays me 1%. Doesn't make any sense. That's the same way you have to conceptualize which sort of annuity to use, and just think of it as individual tools in a tool belt. You're not going to use the back of the back of a screwdriver to hammer in a nail. No, you're going to get a hammer to hammer in that nail most effectively, most efficiently. Same exact thing. Think of annuities as specific tools. So you could use annuities. You can set up annuities through qualified retirement accounts such as IRAs. You can set up annuities with non-qualified money such as cash, savings accounts, different things like that. You can set it up through Roth accounts. So there's a whole plethora of options. It's just using that specific tool to make sure that it's matching up to your specific need. So I don't mean to just knock everything. I want you to be aware of what's available and make sure that you're not stepping into the wrong piles out there that could be complete detonators and destroy your retirement situation. Because in retirement, you only have one chance to get things done correctly. You want to be effective, you want to be efficient, and you also don't want to be scared and sit on the sidelines and miss out on opportunities. As an example, with a solution of, let's say if we have an individual that's age 60, they want to retire at age 65, we understand that they have 5 years of a deferral before they have to actually trigger some sort of lifetime income stream. If this individual has $500,000 of assets comprised of IRAs, non-qualified accounts, Roth accounts, whatever that case might be, $500,000 that's sitting there, Social Security income of 40 grand, pension income of 30 grand, and after doing their budgeting analysis, we figure out that they need $80,000 of income in retirement. Well, 40,000 and 30,000 only equals 70,000. So they are not hitting their income-related goal. What's the smallest amount of dollars and only as much as necessary that they have to leverage with this $500,000 assets to place it into the correct annuity in this example, and then make sure that they're leaving as much money left over for emergency and growth/inflationary needs later on. So this is a little strategy known as the 3-things scenario, and it's saying you want to make sure that you complete step 1 before you move on to step 2. You're completing step 1 and 2 before you move on to step 3. And this example, let's say if this individual is age 60 and the top cash flow that comes back for a 5-year deferral, after doing all that math, it's going to cost this individual $100,000 to place it into, let's just say, IRA number 1, which is with a specific hybrid annuity, an annuity and a fixed index annuity with an income rider. That's going to produce them the cash flow that they need of $10,000. They're receiving the cash flow from the annuity, the cash flow from the pension, and the cash flow from the Social Security income to make sure that they're sufficing their expenses. Out of that $500,000, they only used $100,000 to set up that solution. Now they have $400,000 left over as their fund monies for their emergency need and for their growth and inflationary need. Maybe because they have expenses in retirement at about $80,000. Rule of thumb is to leave about 6 to 12 months of what your expenses are into some sort of emergency fund that you could always pull from. So maybe they want to leave $50,000 into like a money market related account or a savings checking account. That's fine. So that's now account number 2 is set up, not in an annuity, not an investment, just something that's safe and liquid. Maybe IRA number 1 was set up with this hybrid annuity with company XYZ, and that sufficed their step 1 goal. Step 2, emergency, $50,000, and now this individual has $350,000 that they could leverage towards their growth/inflationary need. This is where they could utilize the fund monies. And we have different strategies. We use something known as the REEF method to figure out what this individual's risk tolerance is, what their current situation is with their investments. We look underneath the hood, look at the eggs within their investments. We look at the, we examine everything, see if there's better solutions out there to produce something that's more in line with your risk tolerance, and try to reduce the fees at every angle possible. So this is where, obviously, the three-thing scenario is effective, but we also take it a step further. The name of our process is known as the Retirement Diet Plan, and the diet stands for DIET, distribution, investments, estate, and taxes. So making sure that their distribution is covered before they move on to their investment/growth related need. If they're interested in leaving some sort of, or creating some sort of estate plan or legacy plan, leaving some sort of legacy to their loved ones, to their family members, how to make sure that they're utilizing their chips effectively. And then T, taxes. How to make sure that they're doing the proper, Roth conversions in there. That they're able to look at different accounts available to them to produce some sort of net income that could, that could be most tax favorable for their position. So, obviously, the three-thing scenario is just a small portion of the D and the diet plan, but we try to make sure that it optimizes the key areas of financial planning so that an individual can retire in any market environment. In an up market, they're satisfied. In a down market, they're satisfied. In a sideways market, they're satisfied. So every little angle is covered. If you found value in this video, feel free to call our 1-800 number. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week. You can speak to one of our representatives. They'll set you up with one of the advisors. Just reference this video, and be sure to set up the correct advisor for your situation. An easier route would be to go to our website and set up a calendar appointment through our website. You could either go to the bottom, or you'll have the calendar pop up on the screen. And you could always look at our process, see how we meet with our clients, especially in this post-COVID era. We do different Zoom calls, different phone consultations, face-to-face. It's really whatever the individual's most comfortable with. We send different video messages. We send literature pieces, just making sure that, that educational process is key, and you're most comfortable, moving down the different the different lanes throughout retirement, so that you could accomplish your goal effectively and efficiently. If you enjoyed this video, hit the like button, and feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. I'm making it a point to try to create a couple of videos per week to just further your education and make sure that you do not fall victim to, some of the common mistakes out there. Thanks so much, guys.